on models for CRO involvement in sustainability programs. We'll briefly do some introductions, walk through the purpose of the Risk Officer Sustainability Forum very, very briefly, and then we'll get into the main event, which is a discussion of a survey we carried out and examining the various models for CRO and risk function involvement in sustainability programs. So joining us this morning, we have Alex Duncan, who's Group CRO with Just Group. And I actually went to LinkedIn, and I'm going to do your bio. Alex, I hope you've updated your LinkedIn. So you're a CRO with an actuarial background. I've got the right person, I hope. He's been Just Group CRO since 2012, and prior to that, worked in finance with Old Mutual and various other roles before that again. He's a co-founder of the Risk Officer Sustainability Forum, and he's taken an active interest in sustainability matters over recent years. Hence, he and Alex Hindson co-founded and co-chair the Risk Officer Sustainability Forum. So going in reverse order, Alex Hindson, it's very confusing, two Alexes. Alex Hindson is Chief Risk and Sustainability Officer and previously CRO for Argo Group, and he's been with Argo since 2015. He co-founded the ROSF with Alex Duncan earlier this year and is a member of various insurance industry-related climate and sustainability-related fora. For example, he's chair of the Lloyd's Market Association ESG Working Group. So when I first wrote that down, it said chair of the LMA ESG WG, which is a lot of acronyms in one sentence. And then we have Keith Davies. Keith, head of strategic risk and compliance at Federated Hermes for the last year or so. And it was really interesting. I actually wrote this down with responsibility for creating a modern enterprise-wide risk management function which embeds sustainability and reputational considerations into all investment decisions for a bit more blah, for the firm to deliver long-term commercial success and beneficial outcomes for society and environment, which is really quite impressive, actually. So I'll just go back to my slides if I can find them. There we go. And I'm Chris Burt. I'm a principal with Headless Consulting. I'm also a co-founder and a director of the Risk Coalition. Risk Coalition issued some guidance on what board risk committees and second line risk functions should be doing. We published that in December 2019, and you can get hold of a copy of that if you haven't already from riskcoalition.org.uk. Right. So, terms of reference, what is the Risk Officer Sustainability Forum? Essentially, it's a professional forum for risk executives to help shape the role of chief risk officers in the implementation of sustainability strategies. Scope, it's really, we're doing several things. We have invited participation in roundtable discussions, so that's Chatham House type discussions. Following those discussions, we will be doing blogs and webinars, and this is the first webinar in our series. And part of the scope is to understand the role of CROs within sustainability and in the context of the 3 lines of defense model. And what do we mean by sustainability? Well, broadly it's ESG, but I think it's a bit more than that. So, but it's becoming the de facto name for all this activity. Very briefly, I'm going to just talk people through the survey results that we had. We ran a survey of, I think, around 20 people responded to the survey. And we're simply asking 2 questions. What type of model for sustainability is your organization using? And how mature would you describe your organization in doing that? So just quickly, the definition is model A, isolated, risk function not involved. In other words, the organization is doing sustainability without involving risk. Model B, the risk function has some oversight of a decentralized approach. And then model C, a centralized approach, but oversight, again, provided by the CRO. And then model D, climate leadership, which is where the CRO has executive accountability for climate risk management. But the wider sustainability agenda is managed separately. And model E, which is ownership, where the CRO has an additional executive functional accountability for sustainability. And model F, no model in place, which is a bit of a worry. And in terms of maturity, level 1, ad hoc, level 2, planned, working on it, level 3, managed, probably where people want to be, level 4 is we're doing really quite well. So those are the models, and those you can see are the results of the survey that we carried out. So what I'd like to do is I'd like to open up with Keith to start with. If you would like to give us a walkthrough of the model that you're using, the strengths, weaknesses, and then we can kind of get into a bit of a panel discussion as to why your organization is using that, and what the future might be in terms of where you go from here.
Yeah, thanks, and good morning, everyone, and thanks, Chris, and the Risk Coalition, the two Alexes, for setting up what I think is a great initiative, because I genuinely think this is the next frontier in risk management we need to tackle. Actually, a bit of an advantage going first, because I suspect the reality is that most firms are a mix of the different models, and the actual approach will evolve, will change as firms evolve in the space. I'm lucky enough to have had insight into 3 firms through executive and non-exec for the last few years, and can see that's certainly happening. That you typically move from an initial central star project to embedding in the business as you move towards a more BAU environment. So there might be a bit of a maturity issue as well as a philosophical choice of how you do this. To me, there are a number of reasons why the firm's long-term approach, and for those more advanced, will be decentralised, with the implementation of ESG objectives and activities undertaken across the whole of the business. They're largely positive, but there's also, I think, perhaps just to touch back again at the end, a consequence of the way that sustainability has actually evolved in some firms. The main reason why I think it should be decentralised is actually ultimately all areas of the firm need to be brought into and act upon a firm's purpose, values, and ESG position. And that those values and behaviours need to become part of the firm's DNA and implemented and lived by everybody. To be successful and authentic, I think it's fair to say the ESG approach has to be part of the firm's strategy. And as with other aspects of strategy, like business plans, etc., needs to be delivered by all areas of the business. The design of green products will be done by the product design team. The integration of ESG into investment will be done by the investment professionals. And certain things like diversity and inclusion will require the support of all areas of the business. So it can't actually, candidly, in the long term, be run without getting the support actually on the ground for different activities. However, I think, in contrast, as others will say, a centralised approach is needed to actually try and drive an initial takeoff. But the problem, of course, is that if it's done like that, it may not be undertaken and lived day to day, and may not be embedded in day-to-day activities, and could therefore fizzle out once the urgency or the attention's moved on. But again, I think that said, there's always going to be a need problems for the decentralised approach. You do need a central steer to determine the overall framework, strategy and targets and policies. You can't leave that totally to individual business areas, but you have a very big risk of different areas pursuing different and potentially conflicting agendas. And of course, that can lead to obviously significant problems in terms of reputation, but also other areas where you say you're doing something and another area is doing something different. I think just again, then quickly, the second reason why I think some more advanced firms have done it embedded as opposed to a project is different areas of the business have incorporated ESG earlier than other areas. So I think in financial services, the first place was asset managers. They integrated ESG into investment decisions, and then it moved on to asset owners, perhaps with strategic asset allocation and stewardship. And then actually the third piece that's now becoming around is actually what does the company itself do? Those are outward facing, but what are our values as a company? How do we roll out ESG into our company? So I just think the natural phasing of integrating ESG has meant certain firms haven't taken a centralised approach purely because bits have done it at different times. So that's where I think the business is. I think in terms of risk, I think you need a centralised risk function, particularly in smaller firms, for a couple of obvious reasons. Firstly, it's efficient and effective. You need to gain oversight of firm-wide activities and what is actually ultimately a pervasive risk. In the same way you have a central operational risk team, the operational risk activity is run in different ways in the business, but a central oversight team looks to support, provide assurance, consistency and expertise. The central team actually can help provide standardised frameworks, training, advice and assurance to then be implemented. And of course, you need a bit of a critical mass for expertise in terms of risk skills and sustainability skills that spreading it across the business probably doesn't do. I think a couple of my colleagues will mention that candidly this falls often under the risks officer's remit under SMF and statement of responsibilities. That's another reason why you really want to take hold of it and embrace it. But I think that the really long-term key reason for this is it's actually an enterprise-wide risk. And I think someone, and that's typically going to be the risk function, needs to ensure there is consistency of commonality between the different areas undertaking things. So that you, as I said before, you don't have perhaps the asset managers wanting certain things, say about diversity in their investment process, but the PLC living to different standards, because that creates a disconnect with different stakeholders and reputational damage. So I think that's why, although you have different approaches across the business, you want some common centralized risk function checking that it all makes sense and works. So that's why we are aiming for and on our way to a embedded in the business but centralized risk model, which I think was option B, I think, Chris.
I think so. There's somebody in the background who's got a microphone open, they're clanking around in their kitchen. If they mind going on mute, that'd be helpful. Interesting. So I've written a couple of things down. So using a decentralized model. Now, is that the fastest way of doing this? Or do you think that actually, whilst that might get buy-in across the organization, is it a little bit like, herding cats? Is it probably slower but more effective, or in your organization, is that what they're used to doing?
I think that's fair. I think if you're coming at this from a standing start, a project with the initiative impetus will support initial buy-in, understanding and rollout. But I think in the long term, you actually have to win hearts and minds. So therefore, a project imposing things gets traction early on. But ultimately, as we all know, with projects, sometimes when they're finished and it's chucked over to BAU, it sort of gets dropped amongst the other things. So it needs to be part of day job. It needs to be part of DNA, which does suggest over the longer run you need to have it across the business, in my mind. Yeah. But absolutely, if you're coming new and you want to get up the curve quickly, the focus, the attention, the stick that a project often brings will get you up that curve quicker.
Yeah. And in terms of the hearts and minds, how are you finding it? Are you finding resistance to some of the initiatives that come under sustainability, or is there broadly an acceptance and in fact an engagement that this is the right thing to be doing?
I think, I'll be fair, I think it varies by organisation. I'm currently working in an organisation where it's been part of the DNA for 10 years at least. It's so therefore that it's more putting a framework, structure and organisation around it as opposed to the values and belief in it. In fact, Hermes don't actually really believe there's such thing as ESG. It's a series of risk factors that drive long-term value and ultimately should be considered by all companies anyhow. But I think that the reality is there are different levels of buy-in. Some firms genuinely believe it. Some firms are starting to believe it. Some firms are doing it because if you don't do it, you leave stuff on the table. It's almost table stakes now. So I think in a way that ship sailed. I think there's no way, whether you believe it or not, you won't do it. I think it then comes back to how authentic it is in the long run, whether you actually deliver it over the longer term rather than just, as I say, have a project that says we've ticked the box and we're ESG friendly.
But it's always easier to get something implemented and accepted if people are broadly supportive of the concept behind it, isn't it? Rather than trying to push a boulder uphill. Interesting also how you described it as an enterprise-wide risk. Do you think it is a risk, or do you think this could actually be a massive opportunity for organizations if they look at it in the right way?
It's both. I think, candidly, if you subscribe to the view that embedding ESG delivers long-term value, it clearly is an opportunity. You get it right, you deliver long-term value to all stakeholders and improve the status, standing and financial performance of the company. However, it candidly, like anything else, if you don't deliver it right, you have two risks. One, you don't maximize that opportunity, and if you get it drastically wrong, you can detract from that value. And secondly, I think, and this is an interesting one now, actually, you have to not just deliver it, but you need to be authentic and demonstrate progress in delivering it. Otherwise, you get the reputational damage of being a greenwashing company and not practicing what you preach. So I think there are some real downside risks to this. But ultimately, if you do deliver it, yes, it's a massive opportunity to improve long-term value.
Alex, did you have any questions or thoughts you want to bring into this?
I think probably as we go through the sort of next two parts of the conversation, Chris, we'll draw some differences and distinctions. But there's clearly some commonality, and sustainability both as an opportunity, but also as an enormous potential risk, whether it's reputational or otherwise, is one of the reasons why we have so much interest in this.
Mm. And being slightly cynical, and doing board evaluations and working with non-executive directors, do you think there's been a bit of a road to Damascus conversion amongst many board members, or that they're seeing the opportunity, or do you think there's a genuine, I don't know who I'm asking, by the way, there's genuine interest?
I'm happy to answer that. I think the non-exec community is feeling bombarded, and I've had conversations with a number of my non-execs in the run-up to our next risk committee, and I just started the conversation openly. What's on your agenda? What do you want to talk about? And the three out of three was ESG, and it was largely driven by shareholders, so investment analysts, investors, and proxy advisory firms, and just the news media. So I think Keith's absolutely right. This is a brand protection and reputation risk, but it's also a massive business opportunity. And I think as we'll probably touch on, the board, steering the board in how to pitch that ambition is what this is all about. Is it about threat? Is it about opportunity? Is it about both? And that sets the context of what you're trying to do, and then these operating models are really, how do you deliver it?
Yeah, the actual. So do you think actually the CRO is ideally positioned to be leading? Well, I'll let you talk about the various models that you want to, but I mean, it sounds like, a good CRO shouldn't just be talking about business prevention action to manage risk. They should also be enabling the organization to do things in a safe way that the organization wants to do. And therefore, it sounds like maybe the CRO is a shoo-in for the CRSO role, Alex.
The two Alexes are kind of living model E, but I drew the short straw in kind of positioning model C and D first. So
do you want to outline those models for us?
I won't steal the upper Alex's thunder. I think we all realise that the CRO is well placed to play a role. The debate here is, what is that role? And I think that ultimately comes down to two or three things: culture, and so what kind of organization is it, and where is the CRO positioned on risk and opportunity anyway, irrespective of ESG, but also scale. So part of the reason that Alex are involved in this is that we have organizations of a scale where we probably can't carry a CSO on the exec as well as all the existing roles, and we may not have very large sustainability teams. So I think if you looked at the major global insurers, that's a different business model. So we're really interested in, what do organizations below the kind of massive Alliances, Axes, and Avivas of the world, how do they actually manage this? And I think centralized versus decentralized is a cultural question about the organization. It's not, doesn't need to be about risk or sustainability, but generally it's quite hard to embed things against the grain of the culture. So you end up trying to embed ESG in the same way as you run the company, and that tends to work quite well. So I think picking up model C and trying to avoid just kind of the flip side of everything that Keith said, I think inevitably it is helpful to have a single point of focus and a single point of accountability. And I think one of the interesting features of this is lots of people are interested in the topic, but who takes accountability at the exec, and there's two parts to that. There's the accountability for the program and the accountability for the oversight of the program. And I think in an organization that is new to this, having a centralized program is helpful, both in educating the board and educating the exec as to what it's all about and why it's important. You know, Keith very clearly stated the benefits of decentralized. I think the benefits of centralized are probably around control. So often you see, and that this is the model where the CRO is not leading the core program. So who is actually leading the core program tells you quite a lot. You will get a very different sustainability program if it reports to legal or to communications, which are two quite often the case, or a separate dedicated sustainability function. So that those will tell you quite a lot about how the organization sees the exercise. Is it about, you know, selling the values of the company? Is it about avoiding mishaps, or is it more balanced? And obviously, the centralized approach could lead to tick boxing. It could be that it's all about responding to surveys from all the organizations that send you surveys, be it an ESG index or a FTSE for good. It could be that it basically becomes a coordination and administrative task, and there's no kind of content being driven because it's really about pulling things together. But I think to get started, this could be quite an effective project route because it just brings it all together. And I think the flip side of what Keith said as well is it drives consistency. So you don't have one business unit or one function running ahead, being best in class while the rest of the organization's barely started. And I think it's those disconnects that create reputational risk because you're pretending to be wonderful when actually most of the organization hasn't really started. So I think that's Model C in a nutshell. I don't know if Keith or Alex want to come back on any of that.
I think it's totally valid, Alex. I think, you know, it's that's why I think it does come to maturity of start. So the starting point, I think you're absolutely right. You want central control. If you've already done something and it's already starting the business, you then have to try and match that in a different way. So I think you're absolutely right that the key thing with a central project and central functions is getting that focus, getting that control, and getting consistency from the outset. But say that the sort of the trade-off is with then hearts and minds and buy-in and genuine authenticity as opposed to forcing stuff on people. So it's a trade-off.
And some degree of that centralization helps with the coordination of bits of regulation that are coming into play. So I think many of us are facing the challenges of TCFD disclosures. If we look to Europe, we can see sustainability disclosures coming as well. And so being centralized and being able to make sure the business is moving at the same time will allow you to ensure that the right stuff arrives in the reporting time frame when it should, to the right quality.
I think that is a particular challenge, and we have a New York Stock Exchange listing, and the SEC is consulting on enhanced ESG disclosures, and I think the financial reporting part of organizations are waking up to the fact that non-financial disclosure like this does not have the same level of scrutiny, sign-off, and controls. And I think that's coming in terms of various attestations and verification. And that inherently pushes you to disclose less. And so you've got this debate about when you get lawyers involved of you get sued for disclosing and you get sued for non-disclosure. And so I think in the end, you have to reconcile yourself to the fact you're going to have to because everybody else is.
Do you think it's helpful that disclosures, regulatory disclosures, financial statement disclosures are setting the pace here and driving change? Or do you think that just gives the wrong kind of optics to this and that organizations should be doing this because it's the right thing to do rather than because they're being forced to in order to meet with regulatory requirements? Any of you guys? I don't know which one it was.
Go on, Keith, please.
I think there's two two tiers here. I think that the regulatory piece has two angles. One is to raise the laggards and to make those that are laggards aware, because there's already people doing this in the right spirit and see the opportunity and have done it for many years, whether compulsory or not. I do think the second piece is perhaps to Alex's point that one of the key issues at the moment is consistency and assurance about the disclosures. That people could actually say pretty much free form what they wish, and it doesn't. The front half of the report doesn't get validated in the same way as the financial account. So I think the regulatory piece is not just about raising the laggards to do it, but also doing it at a standard that actually allows people to get a genuine insight into what firms are doing and how they're delivering on their promises, as well as perhaps just putting promises down.
And Alex, sorry, Alex, go ahead.
Sorry.
Go ahead.
No, I was just going to add that I think this consistency point is being driven by the more quantitative end of the investment community. You want to measure everything. And I'm not sure, and this is probably a debate for a whole different day, but I'm not sure that everything to do with sustainability can be reduced to a number, or, if we're generous, 3 numbers, one each for E, S, and G. And you look at different ESG indices, and the actuarial community will understand that if I say that the correlation is about 30% between scores between 2 ESG providers, you realize that there's a lot of variability in what's being measured.
Okay. A question that popped up in my mind as you were talking, Alex H., was to do with the CRO and accountability in terms of, I take your point that the CRO would not be managing the project or the program, and that's probably someone in the business driving that program through. But if you have accountability, regulatory accountability for sustainability, are you then able to exercise appropriate oversight of sustainability within your organization? Is there an inherent conflict there?
There could be, and I think you have to recognise it. And probably in the interest of time, if I can move on to Model D, we can take it as we go. So Model D is where the CRO is accountable for the climate risk management initiatives, particularly in a UK context of the Prudential Regulatory Authority Supervisory Statement 319. So if the chief risk officer is the senior manager responsible, but they don't own the entirety of sustainability, then that's Model D. And I think what it does is it you have the centralized oversight of the whole of sustainability, but you have this carve out effectively where at the end of the day, the CRO is accountable for the delivery of that supervisory statement. And inevitably, it is a project at the moment, because we're in the last 6 months of and everybody from the board and the regulator down is interested in, are we complying, as opposed to what does it mean? And I think inevitably, I think if the statistics that I've seen from various surveys suggest that the CRO is often responsible, and if it's not them, it can be the chief underwriting officer, but that leaves out the investment side, so it ends up being the CRO. The CRO is going to have to look for assurance from elsewhere, and obviously internal audits one source, external consultants is another, but I think it gives the clear oversight. The supervisory statement, if you read it, it is essentially a risk management framework applied to climate. And if you had a blank sheet of paper, you might not have done it that way, but it isn't a bad or illogical way to do it. And the danger is that you lose some of the wider aspects of sustainability and ESG, and people get kind of focused in on climate, and it's effectively saying that climate is more important than the human social side of sustainability. Inevitably, you get a project-based approach, and you get, as the closer and closer you get to the deadline, you get more consultants offering help and more non-execs getting worried that we're not going to comply, and so you get kind of locked into a focus on the deadlines and demonstrating that you've achieved certain things, and sometimes you lose the sense of what's this all about. And a good example, we're not involved, but I've talked to people who are directly involved in the Bank of England stress test, fee-based stress test. Is you can get very fixated on the numbers and forget that the purpose of the stress test is to inform whether you've got a sustainable business model. And I think that's a little bit the problem is you know, the compliance collar, in the sense of feeling the pressure of not complying, can get in the way.
And Keith or Alex D, did you have any thoughts on that?
I'll pick up, I think, a little bit on the climate piece and that, and the single-minded focus, and also on the single-minded focus on the modelling, because I see some risks there, both within the modelling itself and in the social, and in the lack of connection to the social side. But I'll maybe touch on that when I talk about the last model.
Okay, and I should say, anyone in the audience, if you have a question, then please do use the chat. The chat function is open. You simply type in your question there, and we'll try to come to those as we go through. So I think Alex D, actually, before we leap into your kind of model, I am interested by the other aspect of the survey, which is the maturity assessments. Now, when you have a 1 to 5 scale, everyone goes with 3, because obviously that's a safe place to be, which is probably why we have a spike at level 3. But does anything on that maturity assessment, any of the guys on the panel, does that anything surprise you there? I mean, I was slightly surprised by excellence, level 4. I think, you know, someone being hopelessly optimistic, given that this is an emerging topic and people really don't even understand the topic, let alone what you know, excellence might look like. Anything surprise you there?
I think I would have echoed your observation, Chris, is that the concept of excellence, I think, is a relative thing at the moment, not an absolute one. That's
a very polite way of saying.
Well, I think it's fair.
Right, because the topic is emerging, isn't it? So what is excellent?
Yeah, you know, I think it's fair for companies, Chris. I think it's fair for companies to say that, you know, we look around ourselves and look at our peers, and we can see that we're better organised and are doing more in disclosure and have more stuff embedded internally. But really, at the moment, what excellence means when you look across some of the dimensions, I think is yet to be defined. And I think the bars are going to be moving up all the time. So even if you're clearing the excellence hurdle this week, you can't sit in your laurels, because next week the excellence hurdle will be about a foot higher than where you are today.
That's a real point, actually. Okay, and sorry, I interrupted you before you were going to kind of go into your discussion on the model that you're explaining and talking about.
Yeah, sure. So I'm sort of making the case for the CRO as owner of the whole sustainability agenda, which is where I am from an executive perspective at Just Group, and where Alex is as well. And Alex has even managed to slide the sustainability word into his title, which I think will be the direction that many risk officers will go over the next 2 or 3 years, so becoming risk and sustainability officers. I think the case of this is to not think about sustainability in the context of ESG, which is distilling it to the risk factors, but to think about it in the context that Keith described, which is the sustainability of the company, in terms of its purpose, what it's there for, and in terms of its ongoing profitability. And both of those are risk matters themselves in any event. So the CRO sits in a very privileged position, if you like, as a business leader. So very like the CEO, they have sort of whole breadth visibility, and usually as a result of that, their teams have a great network. The CRO has seniority and respect, usually a place at the board, and is probably more holistic and from an enterprise-wide perspective, and probably less revenue and profit driven overall. And as a result, that allows them to be sort of quite balanced as they approach problems within the business. I think sustainability is the sort of problem that requires that balance. There's no question that to take a sustainability program into the organization, you will be drawing on traditional risk officer skills. So you can distill it down to ESG and compartmentalize everything, but this is a large and complicated subject, and it is a whole business system. I have a pretty much integrated company, and it's tough in an integrated company. I have no idea what it might be like trying to roll one of these out over a global organization. So from a sort of whole business perspective, one of the things that risk officers are good at doing is they're good at seeing connections. So if something happens on the left-hand side of the company, what pops up on the right-hand side of the company? And being able to balance that, be able to see everything moving, I think is a real strength that applies itself well to this. The risk officer is good at leading the business through agendas that are evolving, through sort of considerable uncertainty. And there's no question there's considerable uncertainty in where the ESG agenda is going, whether you look at it from the uncertainties that arise on the climate side, or whether you look at it from the sort of social and regulatory pressure. Where will those pressures take us? And the risk officer can usually look at the evolving climate stuff and get behind the modeling and some of the science and whatever else, and at least draw out where the challenges might be in understanding that, but also has an alignment to evolving regulation and sort of thinks about what's on the regulator's agenda, how does that tie up globally, what might be coming next. And then finally, I'd say, from this perspective, thinking on drawing on traditional skills, integrating a sustainability framework and culture into the business is very similar to integrating a risk framework into the business. It touches everybody. Everybody has a role to play. Communicating what that is and what people are expected to do and how that will affect the day-to-day jobs is something that we're sort of doing naturally. It's a sort of built-in, it should be a built-in skill for most risk officers. We've talked about synergy with the climate change work, where the CRO owns that. The way we make that work in my organization is that climate change, as Alex says, is running as a project. And one of my direct reports, one of my senior managers, runs that project, and I sit on steering with that. So I've still got my regulatory oversight of that. We run it as a waterfall project at the moment because there's just stuff that has to be hit at certain times. And that's actually quite different from the way we're looking at sustainability, which is quite agile in its development. There are certainly some bits that have to be hit to timetables, but what we're finding is as we move one part of the sustainability agenda, something else pops up and we have to bring that, that up into line. So we're constantly shifting that. I said I would touch on the ability to divorce climate and just own climate and forget about the social stuff. I was trying to think about an analogy for that. If you think about what we're doing on the investment side, everybody's getting out of coal mining. People don't want to be in coal. The only people who are reluctant about getting out of coal mining, apart from those perhaps that own the assets themselves, are the coal miners, because the coal miners need something else to do. And if you think about the social unrest that we saw in the 80s in the UK as we shut coal mines, those sorts of pressures might be inflicted on other communities as a result of disinvestment. So there's an integration of climate change and sustainability decisions on the social side. So those are sort of some of the positive reasons for the CRO owning the whole model. There are a couple of sort of opportunities, if you like, or you might call them challenges, that we have to deal with as well. So there are skill sets that we have to draw on that we wouldn't usually be accessing. So bringing a whole organization together to build a strategy for a sustainability agenda isn't usually the CRO's remit. It's not something we tend to do a lot of, and it requires us to be more bullish rather than being bearish. So we have to stick our necks out and say, yeah, sure, we can go for this. We can go for this Scope 3 emission target, knowing full well that we don't have a plan that gets us all the way there, but we have an intention. And so that puts the leadership out there. You have to say at the same time, we're not sure how we'll get there, but we're confident we'll make a plan that does deliver that. The second thing that is an opportunity, or maybe is one of these fine balances, and in a way this plays to our skill set, but also I think the extent is maybe a little bit different, is how we have to collaborate with other executives to advance the agenda overall without standing on anybody's toes. And we can do that. We can do that both at exec level, but also by building a strong network at the lower level, or leveraging the network we have at the lower levels of the organization. I said that climate's probably with the CRO anyway, but some of the other larger aspects of interest in sustainability sit elsewhere. So the whole responsible investment framework is obviously going to be sitting with your investment executive. Your diversity might be sitting with your HR team, or in our case, with the CEO. Supply chain management may sit with the finance director. So you have to find a way of working with those executives to advance the sustainability agenda without sort of upsetting anybody too much. And then I thought the last thing that I would touch on just as a challenge is, how do you balance that? If you're taking ownership of the sustainability program, how do you balance the first and second line responsibility? So how do you make sure that while you're driving an agenda, someone's coming along behind you and saying, wait a minute, surely there's a risk attached to that, which is your usual job. To some extent, I imagine the risk officer is thinking about those as he builds, which is what you expect of the whole organization, but perhaps it's more natural for us. But equally making sure that you delegate the responsibility for that oversight, perhaps within your team, to other members who are not directly in the sustainability agenda, is a way of ensuring that those come out.
Right.
And just by way of identifying one of those challenges, part of the discussion that we're having, and I imagine that Keith will be very familiar with, is we have a responsible investment framework. We have sort of an objective in how we move our portfolio over time. We're having to trade off doing the right thing for yield opportunities, and the discussions on those are quite elaborate and can be quite passionate. And we end up with sort of two sides of the argument, and you've got to have somebody speaking for both sides, and then be able to take the two sides of the argument to whoever ultimately has to make the decision and say, look, this is where we think we should be going. So that first, second line can get a little bit grey, but if you have the structures underneath you to diffuse that conflict, then you're probably okay. So that was what I was going to say by way of defending the role as the CRO. I mean, I'm very passionate about the subject, so if you like, I might be making the case from a slight bias.
No, never.
But I do think there are really strong reasons for having the CRO, particularly in small organisations, run sustainability.
And of course, I'll let Alex and Keith come in a second, but the one line of defence we've not mentioned yet is dear old internal audit. I mean, do they have a role to play in all of this?
Audit seem to have a role to play in everything, so the answer is yes. There are some very obvious places where internal audit should be coming into play. So to the extent that you're making external commitments or statements or announcements that will be examined by external parties, then audit's assurance of that is a great comfort to the board. So in our case, for example, we issued a green bond. Mm-hmm. The green bond has a framework behind it, and the framework has governance behind it. And our investment committee is really keen to know that we're following the governance, because the last thing we want is to find that we make a decision somewhere that falls over our green bond and ends up with our financing disallowed. So there are clearly opportunities for audit. That's a very specific example, but depending on the sustainability program and how you're approaching it, it will vary by company, I think.
Yeah. Okay. Alex, Keith, did you have any thoughts or questions based on the model that Alex has just outlined?
No. I mean, I have to say, I think there is a stage development piece. Because the company I currently work in has had a lot of those skills and embedded already. But actually, I think if you do start from scratch, I think for all the reasons Alex said, the CRO team has the skill set to do it for sure, has the experience, has the knowledge, and it is an area of risk. And it's something that risk would have to be involved in. And so at some level, it's totally fine to drive it. As I say, I just think that when you get further into the business, and perhaps for more disparate businesses, it becomes something that is perhaps one where you would want to be the second line supporting and rather than driving, because I think that does create additional challenges.
Okay. And Alex, any thoughts, comments?
Well, I have a very similar approach, and we're at a similar stage in the journey. So I do recognise what Keith's saying. I think there's a point at which it may need to split, but I think at this point it's interesting. We've been working on the flip side of appetite, which is, I've used the word ambition. So if you thought about this as an opportunity, what's our realization plan, and how much are we prepared to invest to achieve it? And I think that's quite an interesting thing to be involved in. It does require consultation, consulting, and sales skills, as Alex mentioned. I think the area that is going to become quite challenging is defining key performance indicators and the inevitable journey towards that being linked to executive remuneration. And I think those things are going to be quite difficult, because, if you said to me today, just on a simple thing like climate, okay, what's your single metric? My concern would be that we could measure it, and what are the unintended consequences. So I think some of these things do need that risk and opportunity thought process at the moment, because there isn't a right answer, and every action has a reaction that may lead to some regret down the path.
I wonder if
Go ahead.
Can I build on that last point, Chris, about sort of measurement and links to remuneration, etc. And from my perspective, I would far sooner that companies are doing the right thing than being able to measure it as accurately as possible. And I do think there is a danger that, we talked about internal audit and what's their role to play. I do think there's a danger that we get obsessed about the numbers. We're a very quantitative industry, that we get obsessed about the numbers, and our obsession about the numbers stops us doing the right stuff. So one of the things that I'm having to labor, if you like, on all of our internal modeling work on climate. We have very fancy models that plot all of the houses that we have exposure to across the UK into their postcodes, and then show you how the tide is going to, or how the floods are going to move, and sea levels are going to move over the next 50 years. And then you go and you read the assumptions, and the assumptions say this assumes that the climate pattern doesn't change. So you ask yourself, well, just how good is my model for 50 years if it's assuming the climate pattern doesn't change? You only have to open the paper to see scientists going, gosh, we're amazed at how quickly the climate pattern's changing. So the value of my model is what? It still is value, it's a discursive value. But to say I have to audit my model to get the right answer is kind of missing the point.
It's really interesting. I was listening to a climate scientist speaking on the radio after the German-Belgian floods the other day, and he was saying that when we built these models 30 years ago, we couldn't evidence them. But turns out we now have the evidence to prove that what we modeled 20, 30 years ago was right. But I take your point about some strange assumptions within some of these models. They do need to be kind of road tested a bit. But Keith, Chris, you look like you want to come in.
Can I make a wider? But I think absolutely, the two Alexes have hit on a really important point here. That the measurability, or the metrification of this, it can be dangerous as well. And an example would be if you wish to have a certain amount of assets or a certain portfolio in green assets, everyone can go and buy green companies now and tick the box, but are making no difference to society. Other companies will go and buy brown companies, being simplistic, through stewardship, engagement and coercion, change those companies to change their position to becoming green, look bad from KPIs of how green's your portfolio at this point in time, but actually make societal difference. So we need to be very, very careful when we're setting metrics, particularly when regarding REM. What are you actually driving? Are you just trying to tick the box and go out and say we have a green portfolio, or are you actually genuinely trying to change society for the better? And I think that's where it comes back to believing in the values and the strategy. We said earlier, you actually have to want to do this, and then you can have different types of metrics to those that are just trying to do it for presentational or sort of table stakes purposes.
And is there an element of longer term thinking?
And I was just reading the ABI's climate roadmap. I finally found some time to read it, and the one kind of concept was interesting in there, which was financed emissions. So they're talking about okay, an insurance company doesn't have that many emissions, but you're financing other people's emissions through your underwriting and your investments. And I think one of the biggest challenges I'm finding in trying to understand how we implement that is, if you just take a very simple example, if you insure BP for 10 million of property insurance, what's your share of BP's emissions? It's not an easy question to answer. And if you insured them for 10 million of general liability, would it be the same number? So I think when we start thinking about this and start assigning our share of vendors and suppliers emissions, or our share of assets under management or underwriters, we're going to have some common understanding of what we're doing, or it's just going to make the measurement and reporting really, really difficult. But the point is back to Keith's point and Alex's point. Doing the right thing involves making those decisions, and that will come down to good old-fashioned risk selection and pricing, and the measurement will follow. But if the measurement gets in the way, we'll never change the risk selection and pricing.
There is we're running out of time now, so I'm just going to quickly wrap up. But if we'd had an American on the call, I'm pretty sure they would have said, if you don't measure it, it doesn't happen. So, and also that remuneration drives everything. I'm thinking of one American in particular that would say says these things. But anyway, so it was interesting how the remuneration point comes through, and also the importance of metrics and measuring performance, but also the message coming through very clearly is that you need to take a longer term view of this stuff, and it's not going to happen overnight, and that you might not look great according to some metrics today, but actually it's the ambition and where you're going, and tracking that progress over time is what's important, and being able to reflect that progress. And also I'm guessing that the goalposts are going to move rapidly over the coming weeks and months and years as the idea behind sustainability matures in terms of what it covers and what people are expecting to come out of this. We did have a few questions pop up around or about some of these things. So ESG seems to be in a collective agenda rather than a competitive agenda. Are there some risks not riding the wave well? That comes from David Carter. Any thoughts on that? Do you want me to repeat it?
Well, sorry, I think that lends into the comments we all said a little bit earlier. There's sort of table stakes and downside reputational risk if you don't get involved. But I think if you get it right, there's a massive opportunity. As Alex said, I liked his phrase, the opposite of appetite. What's the opportunity set? So yes, I think if you don't get involved, you'll be frowned upon. But I think if you do get involved, you have upside benefit, both value and stakeholder perception. But of course, you've got to deliver it, because otherwise that could be even worse. If you say you're going to do something and don't, that also is problematic. Yeah.
One of the stakeholders that we don't tend to think a lot about in our kind of day-to-day work necessarily is our future employees. And what we're finding is that future recruits are much, much more interested in what we're doing in this field than they ever have been before. So we see this as a competitive advantage ultimately, as well as sort of the right thing to be doing and collaborating with other companies. If we say we don't care about this, we don't care about this ESG stuff, we would cut off a huge number of potential future employees, and in future we're going to be cutting off all our customers as well. Yeah. So we do a lot with pension fund trustees, and this question's coming up their agenda too.
I hear a lot about the difficulty in bringing in millennials, and whatever generation comes after millennials, which shows how old I am. That there's a generation after millennials, which
millennials, I think.
Frightening. Anyway, we're coming through to the last couple of minutes, so I think what we'll do now is go through the wrap up. So I'd just like to thank the three of you for a really interesting, fascinating discussion. I've certainly learned a whole bunch of stuff, which is shameful since I listened into the roundtable previously. So there shouldn't have been anything new here, but there was for me. Now, this is the first webinar in what will be an ongoing series of webinars and roundtable discussions. Now, we're planning the next roundtable and webinar in September. We don't have a date fixed yet for either of those, but we will communicate those as soon as we have them. The topic, and this probably is quite kind of pertinent to today's discussion. My screen's locked and it's not scrolling. That's annoying. Oh, there we go. Right. It's is sustainability regulation a neglected area of emerging risk? So that's the topic that we're going to be discussing in September. A whole bunch to unpack there. Is regulation and risk? Start with that one, and moving forward. So again, everyone that signed up to join today's session, we have your contact details. We'll be mailing out information on the next webinar and roundtable. And we'd just like to thank you all for joining. It's been hugely interesting, and we'll put the recording and the slide deck up on the Risk Coalition website in a few days' time. So thank you, Alex, and Keith. We'll have to have 3 Alexes next time to make it easier. And I'd just like to thank you for your time this morning.
Thank you, Chris.
Thanks, everybody. Thank you. Bye.